Right, well, welcome everybody to today's webinar and thank you for joining us. My name is Susie Howard. I'm co-founder and director of MME Group, and for those who don't know us, we're employment market experts within your industry with a network of over 40,000 professionals that we've built up over 15 years now that we've been connected with businesses and individuals on the Northern Beaches, as well as the broader Sydney area. So we are 3 times more likely to find the right match for you, whether you're an employer or an employee, and ensure that long-term success using our unique selection process and aftercare programs. So please reach out to me via email or connect with me on LinkedIn if you want to find out more information. So today we wanted to offer some support to business and individuals during this time, and hence we're bringing together our expert partners to give advice and guidance in their fields. So today we're going to be talking about how to recession-proof yourself with Matt Carter. So Matt's the founder and owner of AFPG Group with more than 20 years experience in financial services industry. He offers holistic financial services, including expertise around taxation, investment, wealth protection, debt funding, estate planning, and cash flow and budgeting. So Matt's been looking after Lorraine and myself forever, and we've definitely benefited from his insights and the holistic approach he takes to financial well-being. So welcome, Matt.
Thank you, Susie. Thank you. Very good of you.
So it's important to stress that the information contained in this presentation, it's general in nature. Doesn't take into account your personal situation. So you should consider whether the information is actually appropriate to your needs and objectives, and where appropriate, seek specific personal advice from your financial advisor. If you've got any questions, please weigh in at any time. If you want to, you can submit those via the Q&A panel at the top of your screen, and we'll try and get back to you at the Q&A session at the end, or through if there's something that sort of comes up that's relevant, and then we'll, if we can't get to them all, depending on how many we've got, we'll come back to you in the next day or so with your answers. So to give you an idea of what Matt's going to be talking about today, he's going to be providing insight into what we need to do to maximise our tax incentives pre-30th of June, which is fast approaching, can't believe it. Protecting your wealth in a recession, so what to do and what not to do. Getting the most out of the current lending landscape, so what are the banks doing, what are the interest rates looking like, etc. And then really a perspective on the markets moving forward, and he's going to get his crystal ball out and tell us all what the economy is going to do in the next few months. So we've got a few questions here, but so we're going to jump right in if that's all right with you, Matt. Sure. Yeah, I suppose sort of start with the biggie. It's recession. We're officially in a recession. So what does that mean?
Look, I think it's obviously a unique situation, and every time we have an event like this, it's always the first time we've ever seen it, and it's sort of never quite the same as last. Go back 10 years ago, and the GFC was the event, and it was likened to the Great Depression, and this was going to be like the Spanish flu. And so economists are always experts in hindsight, and they're always sort of trying to dial things back to what has happened historically. I guess what is evident from central banks around the world and governments around the world is that their response has been generally pretty well crafted and pretty specific and pretty well targeted in terms of getting maximum outcome. The JobKeeper program seems to have done a fantastic job in keeping unemployment under control and providing at least some impetus to the economy. There's no doubt there are certainly parts of the economy that are very much are struggling. There are parts of the economy that are sailing through things pretty much untouched. I guess where this will go it remains a bit of a mystery, but what we do know is that it would appear Australia is much more progressed and much better placed than most other advanced economies around the world. The virus is definitely under control, it would seem. We obviously roll into winter, and I guess that throws up another potential for a relapse, but consistently sort of single-digit infections around the country on a day-by-day basis suggests that we're not going to overload the health system. I guess at some point you would like to believe that a vaccine will come along, but that seems to be pushed further and further out. So definitely there's signs that the economies and the triggers of the economy are starting to come back to full progress and full cycle again. I guess there are areas of the economy that are going to take longer, and international travel, international tourism, which is a very big part of certainly the Queensland economy and the New South Wales economy. It's hard to see that coming back to anything like normal operation anytime soon. It's one thing entirely for the government to say we're going to open borders and we're going to allow it to happen. But I think for most of us, we're going to be very gun shy about hopping on a plane and flying to the States or flying to Europe at the moment. And conversely, you've got to think that people will probably be hesitant to do that in reverse. So, I think it puts a big question mark over the economy moving forward. It doesn't take very much to take the polish and the shine off things. And there's enough cause for concern there that it's hard to see things are going to get back completely to normal anytime soon, albeit, with cafes and restaurants and bars and gyms reopening, businesses will start to become more optimistic. There's been just recently a very specific program around the building industry. They're probably 6 months behind the rest of the economy. People were launching into those construction projects 6-12 months ago. Those projects are still coming to fruition, but if you talk to the industry at the moment, there's just not a lot of new work coming along. So whether this latest government program addresses that sufficiently, time will tell. But there's no doubt the Australian economy is in a much better position and hopefully pretty well placed. The markets, well, I'm sure if we're touching on that later, Susie, but the markets just don't make a lot of sense at the moment. They've rebounded so far and so strongly, and it just beggars belief. I think we've done sort of some forward testing and some valuations of markets, and essentially for the current share prices to be justified, everything needs to go right and everything needs to be back up and running very, very quickly. And as I've just said, we just can't see how that's possible. So definitely feels like markets have got ahead of themselves.
Yeah, okay. So from the individual perspective then, what are we to do to protect ourselves in the short term, seeing as, obviously the confidence hasn't jumped back yet. What is it that we need to do as individuals to look after ourselves?
So I think, none of this is rocket science, and I'm sure most of you have considered it, but fundamentally when things are like this, it's all about cash flow, and it's all about protecting cash flow. Plan for the worst and hope for the best is the old adage, I guess, but it is purely around managing cash flow. So, really trying to rein in expenditure, wherever possible. The banks, are certainly willing to provide repayment holidays and basically waive the need to make repayments on home loans and the like at the moment. So what does that look like? Essentially no repayments for up to 6 months. The interest on the loan will simply capitalise or be added onto the loan. So, $500,000 home loan, where you're paying probably somewhere, or should be paying somewhere around 3%, that's $15,000 a year, it's $1,200 a month. So the home loan balance will go up by $1,200 a month, more than it would have otherwise. Is that a bad outcome? I think if it's going to mean you've got an extra $1,200 or whatever it is in your cash in your bank account and principal on top of that, I think that cash is invaluable, provides a little bit of buffer to deal with that. You know, talking to your insurance companies about deferrals on insurance payments is probably another key thing to look at. Probably the other thing I'd be looking at is how can you streamline your debt position. You know, credit cards and car loans and home loans. Typically where we see clients getting into trouble is when they've got multiple credit sources and they've got multiple payments to make. If you consolidate all that into one payment, be it your home loan, it definitely will improve and make life a lot easier to manage. It also has the benefit of stretching out those repayments over a longer period of time. And you can always make that up later on. So, you know, I guess in short answer, I worry about tomorrow. For today, just focus on streamlining and limiting cash flow as much as possible.
Yeah, because essentially we still don't know, you know, we've talked about construction not sort of feeling it for another little while, and that's the same with a number of different industries. So, you know, there could be further job losses. I mean, do you think that we haven't kind of seen the worst of it?
No, I feel like we have. I feel like it will definitely improve from here. I don't think it will improve as quickly as people would like to believe. It will take a while for some of these businesses to get back up and running. The construction industry will be an interesting one. It is a huge part of our economy. You know, make no mistake about that. And you know, I think for those of you that have dealt with tradesmen in the last 6-12 months, you know, I think they would all tell you that they've all had too much work on, and you can't ever seem to get them back to your house or to your office or whatever it is to do the work that they've promised to do. So how long, I guess, that takes to wash out, and maybe that carries people through. But you know, fundamentally, with home loan rates, you know, at 3% and below, you know, it's very, very cheap. You know, it really is, and I think that will provide a great stimulus for the economy. So I think we definitely feel like we're through the worst of it. Just a question of how quickly it recovers.
Okay. Yeah. I mean, as you mentioned before about cash and that protecting ourselves, if there are, you know, essentially in a recession, you've got to worry about whether you're going to have a job, and so being able to support yourself for a period of time and having that cash available.
Correct. Yeah, absolutely. It's, you know, protecting cash flow, and if that means, you know, you're dipping into the home loan to put food on the table for a period of time, then, you know, that's all right too. You know, at the end of the day, we've all worked very hard to build up equity in our homes. You know, and if we need to dip into that from time to time, well, that's what happens. And you just need to, you know, count on the fact and you know, that you will at some stage be able to, you know, get back to full-time work and get back on top of those and get back within your means and start paying that down again. So you need to take very much a long-term view on this, and best way to do it is manage in the short term.
Okay, great. So we've touched on the markets and you know what the outlook there is, you know, and interest rates as well. I mean, what are the banks doing? Interest rates are low.
Yes.
Are they going to get lower? Are the banks actually lending?
Yeah, so so there's a couple of things going on. The home loan market is quite interesting. I mean, we can talk about commercial lending as well. Commercial lending and residential lending, the first response through the COVID crisis was to tighten up on credit, which was a direct throwback to the GFC, where the banks weren't sure if they were going to have the money to lend. Credit markets around the world became very squeezed. But what we're now seeing is that the banks have a dearth of cash available to them. So all of a sudden their lending guidelines have loosened up again. We're not going to have a credit crisis off the back of this like we did through the GFC. And again, that's been very good, intelligent government responses and central bank responses to make sure that credit markets don't tighten up. So if we fast forward to today where we're at, the banks are certainly starting to lend again. In a residential space, we're starting to see lenders asking questions around COVID and what that means for your current employment. Typically, they're looking at historical financial information when they assess you for a loan, and that is still the case, of course, but they are certainly starting to sniff around and ask what the flow-on effects and impacts have been on your respective businesses or your employment. So that will make it a little trickier for some people. But what we're seeing, and banks, as banks are wont to do, is they will sign us all up on a cheap rate, be it commercial or residential, and then over time there seems to be bracket creep, and before you know it, you're paying 0.5%, 1% more than what you should be. So one of the first things I'd suggest to everybody is to sort of get on the phone to the banks and ask them to review your rate. They're all very, very willing to do that for you at the moment. As a reference point, somewhere at 2.6, 2.7, 2.8 is about the going rate for a home loan at the moment. You can get fixed rates, in the low twos, 2.1, 2.2% for 3 years. So, there's a number of good websites out there you can look at which will provide some research across the industry. One of the ones we use from time to time is called Cannex, CANNEX, and it just lists all the different lenders. And so before you pick up the phone and speak to your respective banks, if you're armed with a little bit of intel around what else is out there, you'll probably find you end up with a better outcome. Will rates go any lower? It's hard to see that. The Reserve Bank has already ruled out negative interest rates, which I think is smart. And fundamentally, there is a cost of funding between the money that the banks are paying for the funds and what it costs them to get out the door. So it's hard to see them moving too much more than where they are at the moment. But it's also conversely hard to see them going up anytime soon either. I would imagine it's probably going to be at least a year or two, probably 2 years before rates start going up. And that's an interesting, we've sort of looked at the outlook and interest rates and how do we get ourselves out of all this government debt that the world has racked up. And the short answer is inflation. If inflation can get back up to 4 and 5%, it will automatically deflate the cost of that debt. So you may find that rates stay lower for longer as the governments around the world try to build some inflation into the system to try and make their debts manageable. So yeah, it's not unusual at the moment to find commercial lending getting back to normal as well. Some of the banks are still being very conservative around their estimates and knocking 20 and 30% off revenue from historic figures and sort of projecting forward with those. But certainly they're lending as well.
Okay. So the big question then, property market in Sydney.
Most discussed asset class in the country. We all love to talk about property.
Yeah.
I think there's no doubt that it's now's a good time to buy. If you've got comfort around your income and your future income, there's some good buying opportunities out there. It's like anything with investing. Doing the opposite to what everybody else is doing, being a bit brave and a bit courageous, can be scary. But at the end of the day, it tends to be when you can make some money and have a good buying opportunity. The challenge, I think, for Sydney property at the moment, there's just probably not a lot out there to buy. What is out there though is definitely worth looking at because you've probably got a distressed vendor looking to sell. And so if you've got some cash and you've got funding lined up, then it's probably a very good opportunity to buy. But having said that, you'll need to be very patient with rents. Rental yields have definitely come off. They were probably 3.5% to 4% prior to COVID, and they're probably down at 2.5% to 3% at the moment. So, but a lot of that is offset by lower interest rates. So the cost of holding those properties, even though you are getting less rent, will be offset by the fact that the bank is asking you for less money to cover the interest repayments. So is it a good time to buy? Absolutely. it just takes courage. And I think through all these things, it's always prudent to have, a plan B and a plan C. Plan A, and everything's going great and everything's tickety-boo and runs along as it is normally. And, what if this happens and what if that happens and how am I going to deal with those things? So, we talk about, insurance, we talk about income protection insurance, we talk about life insurance, talk about streamlining your cash flow, and getting rid of those credit cards and paying off the credit card debts and paying off car loans and just having it all in one place if you can. So just being a little bit careful about things.
Yeah, absolutely. And I think, there's with JobKeeper, we don't know when that comes to an end, what things are going to look like.
I mean, obviously the government's making some noise at the moment about reassessing it in July. I think they had to roll it out for a 6-month period to give employers certainty that it wasn't going to be just, flash in the pan. I doubt very much that they will rein it in significantly, especially in light of the fact that they're $60 billion ahead anyway.
That's right.
You never know, I guess. But yeah, I would imagine it's going to, for most people, continue through to September.
Yeah, sure. Okay. So superannuation, obviously, one of the things that has an initiative by the government was to allow people to take out their super. So it's a big deal, but what does it actually mean if you're to take out super this side of the financial year and obviously next year as well?
Yeah. So, I mean, there's been a lot of debate in the media about the scheme and whether it's appropriate, and it certainly has created some challenges for some of the industry super funds. Fundamentally, I think it was a good idea. At the end of the day, if it provides people with an opportunity to access their future retirement, to put food on the table and make ends meet at the moment, that's great. Conversely, if people are pulling it out to go and spend it on the pokies, which I think was in the papers not so long ago, then you can't legislate against stupidity, I guess, at the end of the day. Look, if again, I think it's about worrying about today, and let tomorrow, take care of itself, and just be a bit organised for the future. Okay, well, I need to make that back up, but if it's going to help me get through the next 3 to 6 months, then that's what you should look at. For those that are interested, essentially, it's quite a simple process. You just need to go onto the ATO website, fill in the form there and make an application, and away you go. We have had clients coming to us looking to pull money out of super and then recontribute the money back into super to essentially create a tax deduction, which is quite a clever idea as well. So you can look at doing those sorts of things. It would, if you pull out the $10,000 before 30 June and tip it back into super, then obviously it'll go back into super at 15%, but you will be able to reduce your personal income tax by the same amount. In terms of what it does for future retirement savings, again, depending on how close you are to retirement, most people have got plenty of time to make that up through extra contributions and salary sacrifice and so forth once things improve.
Just got to commit to doing it.
Sorry, what was that?
You've just got to commit to doing it.
Correct, exactly. It's consider it forced savings. Superannuation gets a lot of bad publicity, but fundamentally it is a very good tax scheme for people. Essentially, that's all it is a way to minimise tax. And throwing extra money into the super at any stage is always a good idea. Especially if you can help use it to reduce your taxation bill. Should you change your portfolio around? Look, that's a really tricky one. Generally, I would say to people, no. The answer is no. I mean, once the market has fallen is absolutely the worst time to do it. There is nothing else on the planet that you can come up with where you would sell it if it became cheap. We become buyers when things are cheap. We've just talked about buying Sydney property because it's become cheaper. but somehow that doesn't translate to people with the share market. And I guess what people worry about is, what if my shares are going to fall to zero? And that just simply isn't going to be the case, and simply isn't going to happen. I guess one of the scary things about the share market is that you can go in there at any moment of any day and you can see down to the cent whether you've made money or lost money. And if I asked you all to think about your house at home and what it's worth, you'd probably all give me a range of somewhere around $50,000 to $100,000. But you don't know what it's worth, and you don't really care because you're not selling. Why is that different to the superannuation? If your superannuation's for 10, 15 years in the future, what does it matter today? So yes, the markets have fallen. They have bounced back and made most of that money back, if not all of that money back. So that's been pleasing. I am worried that we're going to give some of that back again and head backwards. But it's certainly not the right time to be selling money in the markets. Maybe off the back of a rebound, that's a good time to get in. But if you're feeling like you can't cope with the stress of it all, and when you saw your statement and you'd lost 10 or 15 or 20% for that month, and you wanted to run and stick it in cash, then I would argue that you probably weren't invested correctly to start with. But absolutely now is not the right time to be doing that. Certainly doesn't mean it's not worth reviewing what you're doing and having a look at how the money's invested, but making a fundamental change to your asset allocation, the proportion of money that you have in shares versus property versus cash versus bonds. You need to be very, very careful about when you do that. And generally, in this volatility, it's not a great time to be doing it. Sort of, you're in there now, you probably need to ride that out. Albeit, certainly reviewing how that's being done is always pertinent.
Yeah, okay. So putting more in then, I mean, you've already mentioned that, you should at any time to do that, but also pre-30 June,
Yes.
This option of, pulling it out and putting it back in. What about for that tax break, if you're in a position where, you can put some more money in, would you suggest that you did that?
Absolutely. I think, I think the markets will continue to bounce around and they will continue to be volatile, but over the next 5, 10, 15 years, they will continue their march forward, continue their march north. It's been the case for the last 100 years, the last 200 years. So I think you'd be very brave to say that that's not going to happen anymore. But certainly those tax benefits are there. For those of you that are on 40 cents in the dollar or more tax, and you can put it into super at 15 cents, well, that's a 25 cent for every dollar tax break. For every $10,000, that's a $2,500 tax saving. And you will be able to pull that money out of super at some point. The risk with super ultimately is how the money's invested. It's not the superannuation scheme itself. And if we are comfortable that markets will continue to head north over the next 5, 10, 15, 20 years, then putting money into super and taking advantage of those tax deductions and those tax advantages each and every financial year is a really important part of managing your finances.
Yeah, okay. So pre-30th of June, that is literally 2 weeks away. What are the options and, any extra things that we need to consider that we haven't considered?
Sure. So, for those of you that have businesses that are, pretty well positioned at the moment and aren't struggling too much, then it's probably a very different outlook for those that are struggling. Maximising tax deductions pre-30 June is always a nice way to go. I would be cautious about entering into long-term sort of credit arrangements and debt arrangements, with the option, with the thought around minimising tax. Sometimes paying a bit of tax, paying a bit of extra tax gives you that extra freedom around your cash flow and gives you freeing up that cash. It probably outweighs sometimes the benefit of minimising your tax. So it really is going to depend on what your situation is come 30 June. But in terms of what are your options, maximising your contributions into super, so that's $25,000 per person. Prepaying invoices, prepaying interest on loans is another option. And we talked about that super withdrawal scheme. So the government also had some additional benefits around writing off of assets and so forth at the moment, increased depreciation allowances, the purchases of business equipment and vehicles and the like. So those things are certainly worth considering and looking at, and I'd certainly encourage you to have a chat to your accountant about those.
Okay. And from a personal perspective, what if we are on JobKeeper or, is there anything that we need to be doing and considering?
Not especially, no. I think it's probably more about just preserving cash flow and understanding that leaving money in the bank may mean you pay a little bit more tax because you're not doing some of the things you would normally do to reduce your tax. But it's probably I would consider it a cost of funding to preserve cash flow at the moment.
Yeah. Okay.
I'm sorry, just probably the other thing I would just say on that is, for business owners, and I'm sure most of you are, just staying right on top of your debtors, and making sure that those debtors are getting paid as quickly as possible. Maybe you're offering better terms for people that can pay cash in advance or prepay up front, or maybe you need to get deposits and so forth. But again, just be really vigilant around who your clients are and who you're extending credit terms to. Because if you're struggling, it may be that they're struggling, and the last thing you want to end up with is carrying the can if they haven't been able to pay their bills.
Yeah, absolutely. Okay. And so we've just had a question come in. Try and find it. Okay. Actually, a couple of questions that have come in before we sort of talk about the future. But now that it's too volatile to rework my retirement investments, what would be the key indicators in the market that show that it's okay to start to rework them again?
Well, I guess when I say reworking, or we talk about reworking, I guess what I'm counselling caution on is making a fundamental change to the asset allocation. So if you're in a balanced portfolio at the moment, which is 50% growth, equities and property, and 50% defensive bonds and cash, I wouldn't be deviating too far from that, at the moment. It's not to say you can't change how it's done, but fundamentally it's that underlying asset allocation that you need to preserve. At what point is it appropriate to change that? I think what we fundamentally talk to our clients about is what are their long-term objectives. We look at it from a 10 or 15-year perspective and say, right, what is the most appropriate strategy to get you to your lifetime goals? Is that $1 million in super? Is that $100,000 a year in retirement? Is it $50,000 a year in retirement? What do we need to do to get you there? And so I guess it's about forming a view on how much risk you need to take to get there. So if you're 55 years of age and you've got 200,000 in super, and you need to get to $1 million worth of super, then clearly taking risk and investing that money aggressively is going to be necessary. But if you've already got $1 million in super and you've worked out that $1 million is going to get you a comfortable lifestyle, then you probably don't need to be taking very much risk. So I guess it's about taking a long-term view of what is going to get there and what is necessary. And your planner should be able to sit down and do some modelling for you and talk to you about what that is. In terms of the volatility, if you're looking to, I guess, protect yourself through this, then making the changes gradually over time, is probably one way to do it. That way you're only ever going to be half right and half wrong. And what does that mean? Well, if you're currently invested in a growth portfolio, which might be 70% in shares and property, and you're looking to take less risk, then gradually dialing that back. But again, if you're looking to become more aggressive, when the market's had a bit of a correction, that's probably a better time to do it. And if you're looking to become more conservative, conversely, when the market's been stronger for a period of time.
Okay. Yeah. Yeah, look, it makes sense, and it really depends on each individual, doesn't it? And so I'm sure that Matt would be really keen to, catch up with anyone who wants to, for a bit of a health check, put you in touch with one of his team members to talk you through that. Joanne raised a hand. I'm not sure whether this is your question that's come in, but if it isn't, then if you can pop that into the Q&A area, should be accessed at the top of your screen, or you put it in the chat if that's easier. Another one that's come in is where do you suggest that we could invest a sizable amount, i.e. a redundancy? Not a lot of options at the moment, perhaps higher interest earning savings account?
Yeah, it's an interesting one. Again, the starting point is, lifestyle goals and future goals and retirement goals and all those sorts of things. So that should always be the fundamental starting point with everything. What do I need to do to get myself to my future goals? So in terms of defensive assets, and talking about high bearing interest, it sort of suggests to me that the questions come from somebody who's looking to protect that capital. Most of our defensive exposure at the moment is in cash. As uninspiring, as unsexy as that is, we just don't see a lot of value in the fixed interest and bond market at the moment. So we have a significant underweight position to bonds and fixed interest. So certainly cash, whether it's term deposits, or high interest bearing accounts, is unfortunately a necessary evil at the moment. Albeit, you'll be doing well to get 1.5% at the moment. Bonds would be normally the other defensive asset we would consider, and we just don't see value in that market at the moment. Bond prices, the value of bonds move in the opposite direction to interest rates. So as interest rates go up, bond prices come down. So you very quickly offset your interest rates and the interest paid on a bond through a loss in capital value. So we are significantly underweight in fixed interest at the moment. So again, but if you're going to take a long-term view, and if retirement's 10 years away or whatever it happens to be, then putting that money in, investing it with that 10-year time frame and sticking to it for 10 years, not getting spooked by the market. And again, it might be that you're 50-50 balanced, or it might be that you're 70-30 defensive. It's about finding a risk profile that you're comfortable with and seeing it out the course. And provided you stick with it through the full cycle of market fluctuations, you'll generally turn out into a pretty happy place.
It's going to do better than undue mattress, right?
Correct. Probably a little bit safer too.
Yeah, absolutely. Okay, well, if there's any other questions, please feel free to pop them in the Q&A. But really sort of, I suppose wrapping up would be, what the future holds and what's in your crystal ball. So, I mean, is this going to be long-term, do you think? Or do you think that, if you're doing higher interest accounts, that should be for 12 months or,
Yeah, look, I think, as I say, I mean, the markets, and if we follow the share market, it fell around about 35% when all this happened. It was huge. Now, the markets have pretty much made all that back up, and they are pretty much back to where they started, which is just staggering, with all the uncertainty that's going on. And they're talking about a second wave in the US, and infections around the world are still increasing. It just doesn't make sense. Now, there's obviously a lot smarter people than I running around Wall Street making decisions, but there's no doubt we are heading back towards normal, but we're just a long way from that. And at the moment there's we head back into winter in Europe, winter in the States. Does that mean it all starts all over again? So until there's a vaccine, it's just not going to get back to normal as we knew it. But having said that, there are a number of companies that are doing very well. The US market is a little bit distorted by Facebook, Amazon, Microsoft, Apple, and Google. Their share prices have all gone absolutely bonkers. And when you look at the S&P 500 and so forth, that is an index of the largest companies, but essentially those companies are the largest of the large. So they will have a disproportionate influence on what the index has done. But then you've got companies like Walmart who are doing very well as well through retail spending. So there'll definitely be pockets of the economy that do well, and there'll be, Bunnings locally has done very, very well through this, as has Woolies and Coles. But then travel companies are struggling and will continue to struggle. So active management is probably something to think about as well. Historically, passive investment has been very, very positive, but in something like this, active managers, active stock pickers who can pick and choose for you is probably something to consider as well. So we will get back to normal. It will be different to what it was, but we will get back there. It's just a question of how long that takes. But the virus certainly seems to be under control in Australia, so I think that will be sooner rather than later.
Yeah, and hopefully it stays that way, because the second wave, who knows what impact that will have on the economy, as well as all of us personally. But okay. So, in terms of what you're doing, Matt, you sound like you're not expecting that these markets are going to stay the way they are, and sort of, perhaps may drop out again. So, are you just being cautious about investments?
We are. So we are. Sorry, that's my dog in the background. We are slightly underweight equities at the moment. So we're about 4% underweight Aussie international equities. We do have a heavy currency hedge at the moment as well. We expect the Aussie dollar to continue to march north, which will sort of reflect the strong position in the Australian economy and the COVID situation is here. So we are cautious about it. We did take a little bit of profit off the table in the last couple of weeks. And as I say, if there was a big pullback on markets Thursday, Friday in Australia and the US, albeit in the US it bounced again on Friday. So this week I think will be really telling. If markets are behaving themselves and acting rationally, then maybe that pullback continues for another week or so, at which point we might start to sort of make some small adjustments back into the market. But for us, a significant move might be to go from underweight 4% to equal weight. So we're only talking about 1 or 2 or 3% at a time. We're not talking about big changes in our portfolio. We keep an eye on what the relative benchmarks are, and we make asset calls around those. So there are only small changes around the fringes. But if they're done well, they can make big differences to portfolios.
Yeah. Okay. But yeah, did that active involvement in your portfolio, looking at the areas that have done well and have ridden this storm. So,
yes.
Yeah.
Yes. No, that's right. I mean, it's we don't have any property, for example, in our portfolio at the moment. Commercial property. We are worried that businesses aren't going to need the same amount of office space in the future. We're worried that the retailers are going to struggle. It's not to say that they won't get back to normal, but we just think it's a longer road for them. So property is a growth asset. So for us, we say, okay, well, if we've got no property in our portfolio, how are we going to make that up somewhere else? So we're a little bit overweight in Australian shares to fill that void up. So it's about being selective and being active in terms of how you get into the market. There are some really good opportunities at the moment, but it needs to be done carefully and cautiously, because it's easy to put a foot wrong.
Yeah. Okay, great. Well, is there anything else that you want to add, or any other questions anyone wants to ask?
No, so I mean, look, thank you so much for your time today, Susie, and allowing me to speak. Happy to have a chat to any of the participants. If that leads to an appointment, great. If it's just a phone call and you just had some questions that you wanted to ask directly, happy to do that as well.
Yeah,
So please feel free to reach out via email or LinkedIn or through our website. More than happy to have a conversation.
yeah. I need to book some time with you as well. So we have just had something come in that just going back to the personal cash flow. Do you have some tips on how to build reserve or emergency funds quickly?
Yep. So equity in your home is probably the first place I would look. So if there is equity available in your home, borrowing, as much as the bank will give you, or more than perhaps what you've got at the moment, you don't have to use it. So it's a bit like a credit card limit. If you're not using the credit card, you don't get charged interest. But the banks will generally lend up to 80% of the value of the property without mortgage insurance, subject to serviceability. So for most people, having equity and having some cash flow reserve available through their mortgage is the best way to do it. Paying extra off your mortgage, at the end of the day, the interest bill is whatever it is, and every cent you pay over and above that interest bill is coming straight off the principal. And as I mentioned earlier, just minimising the number of commitments that you have, the financial commitments, the credit cards, the car loans, the personal loans. Almost without exception, every time we see a client in financial difficulty, they've got 4, 5, 6 of these things. If you can keep it all in the one place and it's just one repayment every month to the bank for your house or whatever the case may be, you'll find immediately a huge impact on your cash flow. You're not trying to find $200, $300 a month for your credit card, because on your home loan that equates to $20 or $30 repayment. So the house and the home loan is a real good place, and if your income will support it, you've got the ability to go back to the bank and borrow a bit more for a rainy day. That's a nice place to be. Whether it's through an offset account or through your redraw, either or, the house is a good place to be.
Yeah, good advice. All right. Well, I think it's probably time to wrap up. Obviously, feel free to ask any questions afterwards. Matt will be available to answer those, and as he mentioned before, have a bit of a catch up on the phone if you want to have a chat about your personal circumstances, because as you know, this was general advice. So yeah, I mean, if there's thank you, Matt, for your insights, and I think I've learned a lot today, and it's given me food for thought, and hopefully it has for everybody else. The webinar will be available for you to access, so you can revisit it if you need to, and we will share that into our professional hub, so that's our LinkedIn group, where all information, and you can ask questions through their format to answer as well. So yeah, once again, thank you very much. Thanks for joining us, and we'll see you next time.
Thanks, Susie. Bye-bye.
Thanks a lot, Matt. Appreciate it. Cheers.